right, let's get right into it. Something really big just happened deep inside the US financial system. And here's the crazy part. Almost nobody is talking about it. So it all kicked off back on October 31st. The Fed, pretty quietly, pumped a huge $29 billion into the banking system. Now, that alone was one of the largest of these operations we've seen in years. But it turns out that was just the appetizer. Because then, boom, November 28th hits and another spike, completely out of the blue. This time for $11.3 billion in what is essentially emergency overnight cash. And it didn't stop there. Just one trading day later, on December 1st, it happened again. Another $13.5 billion. So you add that all up, and you're looking at nearly $25 billion of emergency money flooding the system in just 48 hours. That is not normal. So you're probably asking, okay, what's the big deal? Well, let me tell you, injections this big, happening back to back like that is super rare. And historically, when the Fed has to jump in like this outside of a full-blown crisis, it really only means one thing. The plumbing of the financial system, the pipes deep inside, are under some serious stress. Look, you have to understand, this isn't just random market noise, no way. This is a signal, a big flashing red light coming from the very heart of the financial world. It's a pattern, and it's telling us the system is really starting to feel the pressure. Okay, to really get why this is so important, we've got to pull back the curtain and see how this all actually works. So let's break it down. What in the world is an overnight repo? Right, so a repo, it's just short for repurchase agreement, and really, it's just a super short-term loan. A bank gives the Fed something valuable, like a U.S. Treasury bond, and the Fed gives them cash, but only for one night. The very next day, the bank has to buy its bond back. You know, the easiest way to think about this, it's literally Wall Street's pawn shop. A bank is short on cash for the night, so they take their most valuable asset, think of it like a prized watch, but in this case, a treasury bond, and they pawn it to the Fed for quick cash. But here's the crucial part. Banks hate doing this. It's a last resort. They only go to the Fed's pawn shop when they're desperate for cash and they can't get it from other banks. That tells you cash is getting tight, and maybe, just maybe, trust between banks is starting to run a little thin. And listen, this is not the first time we've seen these warning flares go up. These repo spikes have a pretty chilling history of being the early tremors right before a major market earthquake. I mean, just look at the timeline. It's kind of uncanny, right? Back in 2000, repo's use surged just a few months before the whole dot-com bubble burst. Fast forward to 2008, same story. The Fed was injecting liquidity long before anyone was talking about Lehman Brothers. Then in 2019, the repo market completely froze up, 5 months before the COVID crash sent markets into a tailspin. And just last year, 2023, big repo spikes popped up right before we saw those regional banks start to fail. The pattern is just crystal clear. These things are the canary in the coal mine. And hey, speaking of seeing things clearly, if you like our videos, please like, share, and subscribe to follow us so you won't miss any exciting updates. Okay, so that leads us to the billion-dollar question, or I guess the $25 billion question. Why now? What's going on in the background that's causing all this stress in the system today? This chart really gets to the heart of it. The U.S. government is issuing a mountain of new debt, treasury bonds. But look, the usual buyers, foreign countries, they're not buying as much anymore. So who has to pick up the slack? Yep, U.S. banks. They're being forced to swallow more and more of this debt. And that creates this really dangerous situation. The bank's balance sheets are stuffed to the gills with these treasury bonds. Now, bonds are great, but you can't use them to pay your bills day to day. You need actual dollars for that. So the banks are becoming asset rich, but cash poor. And that, my friends, is the exact recipe for a breakdown in the repo market. So we've seen the warning signs. We know what's causing the problem. The next logical question is, what happens next? What does history tell us we should be looking out for? Well, history has a pretty well-worn playbook for this. First, you start to see volatility tick up. The VIX, which is basically Wall Street's fear gauge, it starts to get jumpy. Then, the Treasury market itself, the bedrock of the whole system, it starts to get unstable. After that, inevitably, some major bank or a big fund suddenly admits to huge hidden losses. That's when the panic can really set in. And that, of course, forces the Fed to jump back in with even bigger bailouts. And all the while, you'll see investors running for safety in real assets like gold and silver. So when the pros see these signals flashing, what do? Well, it's not about trying to time the market perfectly. It's all about preparation. They start holding more cash, keeping their powder dry. They cut way back on debt and leverage to lower their risk. They get out of any weird, complex investments that they can't sell in a hurry. And yeah, a lot of them start looking very seriously at physical assets like gold and silver, things that tend to hold up when everything else is shaking. So look, a $25 billion signal coming from the deepest, darkest corners of the financial system, that's not just a minor detail. It's a huge message. It's telling us that the pressure is building and the Fed is already having to step in. What we're seeing right now, this is what happens before the crisis. The real question we all have to ask ourselves is, what comes after?